This week, we will study trading with asymmetric information. So last week, we studied portfolio choice under asymmetric information, but essentially investors took asset prices as given. And so now we'll focus more on market microstructure to understand the formation of asset prices and all the factors to take into consideration when buying or selling assets. Okay, so what does asymmetric information mean? So it's distinct from the notion of symmetric information. So under symmetric information, there might still be some uncertainty, but uncertainty is the same for everyone. Okay. With asymmetric information, we take into account the fact that different agents are going to have different information. In particular, some agents will be uninformed. So in this context, so how should different types of agents trade? How are they going to buy and sell assets? And also what are going to be the resulting asset prices? It's not completely clear. So in particular, uninformed investors know that they are uninformed, but that other investors are informed. So perhaps they'll be able to infer some information, whether from market prices or from observing the trades of other economic agents. Okay, so in other words, these investors are uninformed, but they may still be rational. They may still be able to gather some information from publicly available data. Now, so for these informed investors, so those who have some specific information that uninformed investors do not have, they also know that they are facing investors who are less informed than they are, right? So for these investors, there is now what's referred to as a strategic dimension to trading. And so in this sense, so what does strategic mean? Strategic means that when they will trade, they will take into account the effect of their trade on the actions of other agents. Okay. And so based on that, they may change their trading. Okay. So in other words, they're going to take into account the price impact of their trades in this specific context. Okay, so we'll see what it means to trade strategically. Okay, also we're going to understand how market prices emerge. So last week when we studied the Grossman-Stiglitz model, for example, we took the market price as given. Okay, so agents were not being strategic, and the market price, was just established to clear markets. Now we're going to understand a bit better how market prices are formed. Okay. So there are going to be some informed investors who are going to trade based on their information. So it's going to be informed trading. But in this type of model, there's also going to be some noise traders, also referred to as liquidity traders, whose demand is not going to be based on information. And so it's, in this sense, it can often simply be viewed as just random demand that can depend. So they can trade based on noise, they can trade based on liquidity needs, whatever that is not information related. Okay, so you have these two types of investors. So some with information-based tradings and other whose trading is not information-based. And then you're going to have some market makers. So these are the agents effectively setting the market price. And so there's different interpretations for market makers. There's some markets such as the NASDAQ, where there are some market makers who are setting the market price. We can also view them as an abstract representation of how markets work. So there's different interpretations. We're going to remain agnostic about this. And so these market makers, so based on all the orders that they observe, they're going to set the market price at which trades occur. And they will supply liquidity. They supply liquidity because they absorb the order flow. So they're going to buy when investors are selling and to sell when other investors are buying. So they are supplying liquidity, whereas other investors are demanding liquidity. Okay. And so this is one of the services that the market makers provide, and they are supplying liquidity. Of course, they will be compensated for this service, right? They do not do that for free, in the sense that they might be on the wrong side of the trade. So they are going to require some compensation. We're going to see what it looks like. So of course, market makers are not stupid. They might have less information than all these traders who trade based on their information. But they will try to infer some information from the trades that they observe. So for example, if they see that investors are mostly buying stocks, they may infer that perhaps they have some positive information about the fundamental value of the stock. Okay, so then they're going to set the market price accordingly in such a way that in expectation, they are not losing money. Of course, for them, it's not easy. What's not easy is that they don't really know the reason behind each trade that they observe, right? Because if you take all the trades which are not information related, so for example, noise trade or liquidity trades, they are not based on any information about the value of the asset. So in principle, the asset price should not react to any such trades, okay? Because again, they don't carry any information, so they should not affect market prices. On the other hand, there's some trades that should be met with a price adjustment, and these are informed trades because they are based on superior information about the value of the asset. So for example, when investors are selling, it suggests that the asset price should be lower, okay? But now, of course, the market maker does not know who submitted some market orders and what was the reason behind this market order. So you may say, well, perhaps market makers could simply ask, right? Sometimes the market makers actually know who is submitting an order. So why don't they just ask this investor if the order is liquidity based or information based? But would they really be able to do that? Because remember, so the liquidity trades should not be met with a price adjustment, but the information-based trades should. So in this case, any investor who was asked by the market maker what is the reason behind his trade would simply pretend that it is purely liquidity-based. Okay, so that the trade would not move the price against this investor. Okay, but then if any investor would say that their trade is liquidity based, then it's just pointless for market makers to ask, right? Because investors have an incentive to lie. Okay, so market makers, just in summary, market makers will not be able to know what is the reason behind a particular trade. Okay, so try to understand how everything fits together, and to try to derive some insights into trading and asset prices under asymmetric information. We're going to study this pretty simple model, which is known as the Kyle model. Okay, so we're going to make things as simple as possible, but not simpler. So there's an asset. Think about a stock with a future random payoff. So the payoff d tilde, you can think about it as the fundamental value of the asset. And so everyone has some information about this. So we do not know what this asset payoff is, but we know that it follows a normal distribution with a mean of d bar and a variance of sigma square. And why normal distribution? It's mostly because it's going to be quite convenient for belief updating. And there's 3 types of agents, 2 traders and 1 market maker. So the first trader, so he's a risk neutral insider. Insider in what sense? In the sense that this person has some perfect information. So this informed trader knows exactly the realization D of D tilde. Okay, so this person knows exactly what the value of the asset is. The asset is worth D, and this informed trader knows D. And so he's going to trade based on this information by submitting the market order, demanding a quantity X, which will be a function of D. So typically an increasing function, right? If you have, if you know that the fundamental value is higher, you're going to demand more of the asset. But right now we don't know that. And market order. So what does this mean? A market order is simply that you demand to trade a given quantity, here a quantity X, and you want to trade at whatever the market price is. Okay, so their motive for trading is information based, and so often we say that these people engage in speculation. Now there's some noise traders or liquidity traders, so that's the second type of trader, and they're going to submit a market order which is not information based, and so we're just going to assume that it's random. So sometimes they're going to be buying, sometimes they're going to be selling different quantities. So let's just assume that this market order U is normally distributed with a mean normalized at 0 and a variance of sigma U squared. Okay, so this variance represents the magnitude of noise trading. Now, the larger sigma U, the more noise trading there is. For example, if sigma U were equal to 0, there would not be any noise trading. And to make things simple, and also because we assume that this demand, this trading was not information based, U is independent of the fundamental value of the asset. So these trades are purely random. Okay, so you have these 2 traders who submit market orders. So the orders observed by the market maker are going to be X and U, the quantity demanded by both types of investors. And so the market maker is risk neutral, to make things simple, and competitive. Competitive means that the market maker will, in expectation, break even. So it's going to make 0 profit. And the market maker does not observe each individual order, X and U. Instead, it's going to observe the total order flow, meaning that it's going to observe the sum of X and U. It's going to observe X plus U. So he's going to observe X plus U, but he's not going to know who submitted which order. Okay, he observes the total order submitted to him. Okay, and so trading is sequential. So first, the insider and the noise traders are each going to submit market orders. And so here, this is a bit different from what we had in the Grossman-Stiglitz model. In the Grossman-Stiglitz models, they submitted a demand function. Now remember X as a function of P. So their demand was a function of the price. And so we said this can be viewed as a set of limit orders. And here instead, each of them submit a demand. Demand can be either a buy or a sell order, and negative demand means that you are selling. And so this is independent of the market price. X is independent of P. But of course, now X depends on the information of the insider. So it's a function of D. And so then the market maker is going to observe the order flow, so X plus U, and is going to set the market price P as a function of the order flow in such a way that the market maker is going to break even, so make zero profits. Okay, and everything is very simple, so there's no credit constraints, so people can borrow if necessary. There's no restrictions on trading. You can take very large positions. You can sell the asset. You can short sell the assets. Okay. All right, so how does this work in the model? So to solve for the equilibrium, so an equilibrium is a combination of two things. There's the market order, so the quantity that the only optimizing agent who is trading, so the insider is going to trade. And so the market order X of D. And an equilibrium is also characterized by the market price. And the market price P is going, so it's set by the market maker. And so it's going to depend on the information of the market maker, which is the order flow. And the order flow is X plus U. Okay. Whereas the market order depends on the information of the insider. The information is simply the realization D of D tilde. Okay. And so how are these two variables set? So the first one is set by the optimizing behavior of the insider, which trades based on its information. And so the quantity X of D is going to maximize the expected profits of the insider. Okay, so the insider is going to choose X to maximize the expected profits. And here we take the expectation conditional on D because the insider trades based on his information. So what are the profits of the insider? So here essentially why the profits, because the insider is risk neutral, so expected utility is simply equal to expected profits. So the profits are going to be two things. So the insider is going to own some assets. He's going to have a quantity X of assets in his portfolio. And what is the profit is going to make on each unit that he bought or sold? Well, it's going to be equal to the value of this one unit of the asset minus the price, the market price of the asset. So whatever the insider paid to buy or sell this quantity of the asset. And so for example, if X is positive, the profits of the insider are going to be positive if D, the value of the asset, is larger than the price of the asset. Okay. Conversely, if X is negative, if the insider sold, profits are going to be positive if this whole term here is negative, meaning if the market price is larger than the fundamental value D of the asset. Okay. And here we take into account the fact that the market price takes this form. So it's going to depend on the order flow. Okay, so that's for the quantity X of D demanded by the insider. Let's look at the market price now. So the market price, P, is going to depend on the information of the market maker, which is X plus U. And the market maker is supposed to break even. So the profits of the market maker are going to be zero if and only if the profit per unit held by the market maker are zero as well. But this is the case if and only if in expectation, the value of the asset is equal to the price. Okay. And in expectation, conditional on the information of the market maker, which is X plus U, and we have X plus U here as well. Okay, so in other words, if this condition is satisfied, then in expectations, the market maker will make zero profits, i.e. He will break even. Okay, so how do we solve this model? So it's like with the Grossman and Stiglitz model. So we need to postulate a linear equilibrium. So why is that? The problem is that to determine the optimal demand of the insider, we need to know what the price will look like. But to determine what the price will look like, we need to know what will be the optimal demand of the insider. Okay, so we need to start somewhere. And to do so, we are going to postulate a linear equilibrium in the sense that x of d is going to be linear in d. So here b, capital B is a constant. So x of d would be a linear function of d. And moreover, it would be equal to 0 when d is equal to d bar. Okay, meaning when the true value of the asset, d, is exactly equal to the expected value of the asset. So it makes sense. What about the price? The price, likewise, is going to be a linear function of the information of the market maker who sets the price. So this information is just the order flow, x plus u. And so the market price is going to be a linear function of this order flow in such a way that when the order flow is equal to 0, so when x plus u is equal to 0, the market price of the asset is equal to the expected value of the asset, which is just d bar. Okay, and so here capital A is also a constant which has yet to be determined. Okay, so let's start with the maximization problem of the insider. So we want to maximize this objective function over x. Okay, so here I just rewrote the same objective function. So now we're going to use the expression that we have here for the price. Now we know that the price is going to look like this, even though we don't know what capital A is yet. Okay, so here I just replace the price by this postulated expression for the price. Okay, and I get this. Now the next step is to take expectations, right? So here I have a conditional expectation, so conditional on d. So I'm going to get the expected value of d tilde conditional on the realization d of d tilde. So that's simply d. Minus d bar, that's a constant, so that remains a constant. X, that's constant from the perspective of the insider. A also is a constant. And then I'm going to have the expectation of u tilde conditional on d. Okay, so what is that? Actually, it's right here. So I'm going to get the expectation of u tilde conditional on d. But because u and d are independent, this is simply the expectation of u tilde. And the expectation of u tilde is equal to 0. And this is what we have here. Okay, so this objective function for a given value of x, for a given quantity x demanded by the insider is simply equal to this. So now we want to maximize this expression over x. Now remember, right now we just rewrote the expected profits of the insider. So how do we maximize this over x? Well, first of all, as you can see, this function is concave in x, globally concave, meaning that the maximum will be given by the first order condition. Okay, so we take the first order condition with respect to x, and you should try to do this at home. We rearrange and we find simply that the demand of the insider, x of d, looks like this. Okay, so here, if you take the first order condition, you get that x is equal to this. And to take into account the fact that x is going to depend on d, we rewrite this as x of d, x as a function of d. Okay. But now let's compare this expression to what we postulated for the demand of the insider up here. If you compare these two things, immediately you get that B is equal to 1 over 2A. Okay, so this is the first equation that we needed to solve the model. Okay, so now we're going to get another equation that relates B and A using this second equilibrium condition. Okay, so again, here I just rewrote the equilibrium condition here. Okay, so what can we say about this term? Well, here it's simply a conditional expectation. So now we're quite familiar with the concept. What is this equal to? So it's equal to the unconditional expectation of d tilde, so that's d bar, plus this term which reflects belief updating by the market maker after the market maker observes the order flow. So what is a surprise term? So the surprise term is going to be equal to the observed order flow. So that's x plus u. This is a realized order flow, minus what you expected the order flow to be on average. Okay, and this is the expectation of the order flow. And so how is this surprise term going to affect beliefs of the market maker? So it's going to depend on this beta term that we have here. Okay. And in particular, it depends on the covariance between the fundamental value D of the asset and the order flow. So how are these two things related? And so how much do I update my beliefs when about one when I observe the other? Okay, so that's quite straightforward, right? So we're going to get the covariance between D tilde and U tilde. And what is this equal to? Well, we remember that U is independent of D tilde, so the covariance will be equal to 0. So this whole covariance here will simply be equal to the covariance between D tilde and X tilde. But what is this equal to, right? That's when it's useful to use this expression for the demand of the insider. And we know that in covariances, we need to use unconditional expectation. So X tilde, what is X tilde? It's X of D tilde, which using this equation here is equal to that. Okay, so when we throw this whole thing in a covariance term, we have B, which is a constant, D bar, which is a constant. So the only thing that remains is capital B times D tilde. And so we're going to get the covariance between D tilde and capital B times D tilde. But that's just B times the covariance between D tilde and D tilde, which is the variance of D tilde, which is sigma square. Okay, simply because here X tilde just can be replaced by that term. Okay, so likewise for the variance of X tilde plus U, so it can be decomposed. So the variance of the sum can be decomposed into the sum of the variances, simply because, again, the covariance between X tilde and U tilde is equal to 0. So the variance of X tilde, so that would be the variance of this. That would be B squared times the variance of D tilde, and the variance of D tilde is sigma square right here. That's what we have, plus the variance of U tilde. And by definition, this is sigma U square. Okay. Now, x plus u, well, this is whatever the realization of x plus u is, minus the expectation of x tilde and minus the expectation of u tilde. So what is the expectation of x tilde? Well, we take the expectation, so this is x tilde, we take the expectation on both sides of this equation. And so we get that this is equal to b times the expectation of d tilde minus d bar, but the expectation of d tilde is d bar, okay? Meaning that the expectation of x tilde is 0. Now we have the expectation of u tilde. But again, that's easy because the expectation of u tilde is equal to 0. Okay. So after all this work, we find that the market price of the asset as a function of the order flow, x plus u, is equal to this linear function of the order flow. Okay, you should try to redo it at home, make sure you find this expression as well. Okay, so now what is the last step to solve the model? Well, so remember the expression we postulated for the price in the previous slide. Okay, the price is equal to this, d bar plus capital A times the order flow. But the price is also equal to this, d bar plus this ratio times the order flow. Okay, so now if we equate these two equations, so this is what I did here, we get that A is going to be equal to this. Okay, so why is that useful? Because we already had one equation that related B to A, and now we have a second equation that relates A to B. Okay, so we have just a system of two equations in two unknowns. Now the two unknowns are capital A and capital B. And so if we just solve the system of equation, we are going to be able to express A and B as a function of model parameters. Okay, so let's start with the first one, A. And here I rewrote it as 1 over A, because 1 over A is a measure of market depth. Okay, so market depth is an important measure of market liquidity. And it is telling you by how much the market price will move in response to orders. And in particular, the deeper the market, so the greater market depth is, the smaller will be the impact of order flows on prices. Okay, so people can trade a lot without moving prices much in a deep market. Okay. And so it is model. So what are the determinants of market depths? Well, here the model tells us two things. First of all, to have a deep market, so a very liquid market in which market orders do not move the price much, you need to have a lot of liquidity trading. So the larger sigma u is, the deeper the market are going to be. And why is that? Well, it's pretty straightforward, right? In principle, liquidity trades are not informative about the fundamental value of the asset, and so they should not move market prices. Okay, and so it makes sense that when there's more liquidity trades, market prices are going to be less sensitive to trades. The second component is sigma here. Okay, and so what is sigma? So now we need to think more about what sigma represents. So sigma is the uncertainty about the value of the asset. Now, of course, from the perspective of the traders, there is no uncertainty because this trader knows D. But from the perspective of the market maker, this uncertainty is very relevant. And so here sigma measures the informational advantage of the trader, of the insider, here compared to the market maker. Okay. In other words, sigma can also be viewed as a measure of information asymmetry between the insider, who perfectly knows D, and the market maker, who at first only knows that the asset has a variance of sigma. Okay, so the larger sigma, the greater the informational advantage of the insider relative to the market maker. And so here what we have is that the market depth is decreasing in this informational advantage. Or in other words, market depth is decreasing in the amount of information asymmetries. And it makes sense, right? If there's lots of information asymmetries, it means that trades are all else equal more informative because the market maker has more to learn from prices. Okay. But then market prices will be less liquid because it would be more likely that the market maker would be on the wrong side of the trade. Okay. So to summarize, so what is a deep market? So a deep market is a market with a lot of liquidity trading, so a high sigma U, and minimal information asymmetries, so a small sigma. And on the contrary, an illiquid market will be a market with not much liquidity trading, and a market with important information asymmetries. So when sigma is large, meaning that the trader, the informed trader, the insider, knows much more than the market maker does. Okay, in that case, it would be expensive to trade in the sense that the market will not be very deep, and that market prices are going to have a strong, in that trades are going to have a strong impact on market prices. Okay, so that's for 1/8, which is a measure of market depth. What about the second? And actually, before we do that, so why was A really a measure of market depth? You can actually see that from that equation, right? Because in this equation, A is by construction a measure of the sensitivity of the market price to the order flow. Okay, so the larger A is, it means the more sensitive the market price is to the order flow, meaning that the market is not very deep. The order flow is going to move the asset price a lot. Okay. Now, what about this second parameter B? So what is B again? Well, B is the sensitivity of the insider's demand to the insider's information, D. Okay. And so the larger B is, the more aggressively the insider is going to trade based on his information. Okay. So it measures, B is a measure of the trading aggressiveness of the insider. Is he going to buy a lot when he has some positive information, or is he going to sell a lot when he has some negative information about the value of the asset? Okay, and so what is B equal to? And here you can see in this model that B is directly related to the depth of the market. And the deeper the market, the more aggressively the insider will trade. Okay, so it makes sense. When trades barely move the asset price, the insider can trade a lot without moving the asset price much. And then to maximize his profits, if the asset price is not very sensitive to X, to maximize his profits, the insider will trade a large quantity X, whether X is positive or negative. Okay. But of course, the insider will not trade an infinite quantity, even though he's risk neutral, right? So the insider here is not trying to reduce the amount that he will trade based on risk aversion, because it's risk neutral. So the reason why he will not trade infinite amounts is because the insider is strategic, because it takes into account the price impact of his trade. Okay, so that is a strategic dimension to trading. And where can we see that? We can see it actually from the insider's optimization problem. So the insider is maximizing this function. And so it takes into account the fact that, let's say you have some positive information, right? So D is larger than D bar. So the insider takes into account the fact that increasing X will increase profits because it will increase the per unit profit that is made. But increasing X will also increase the asset price because A is positive. And so the more the insider buys, the more the market price is going to move against him, thereby reducing his profits. Okay. And so to mitigate this, the insider is not going to trade such large quantities that he would fully reveal his information. Okay. So he will strategically demand lower quantities, so smaller buy or sell orders, in order to not fully reveal his information to the market maker. And you can view that as the insider trying to disguise his trades, trying to not reveal his information by submitting very, very large amounts. So this is what I'm telling you right here. So the insider is really to try to minimize the price impact of his trade. But of course, he needs to trade to some extent to have to be holding some quantity of the asset and to make some positive profits. Okay. And so how is he going to solve this trade-off? Well, it all depends on the price impact of his trades, right? If the price impact of trade is pretty low, then to maximize profits, the insider is going to trade a lot to maximize the profits here. But if the price impact of trade is high, meaning the price P is very responsive to the order flow, that includes the quantity X demanded by the insider, then the insider will trade pretty small quantities. Okay, so it all depends on market depth. And market depth in turn depends on the amount of noise trading and on the informational advantage of the insider. Okay, so that's pretty interesting. I'm coming from a very simple model. Okay, what else? So we can calculate a few other things in this model. And in particular, we can calculate the amount of trading, the proportion of trading, which is coming from the insider compared to the noise traders in this model. Okay. And so for these purposes, because in expectation, X tilde and U tilde are 0, we're going to use the variance. Okay. So this gives us a measure of the intensity of the insider's trading. And in the denominator, we have the intensity of overall trading. Okay. So here we have X tilde. We replace that by the expression we have here for X tilde. That gives us this quantity. Again, d bar is a constant. So we take the variance of this, which is equal to that. Same thing in the denominator. It's actually something we already calculated here. Okay, so we just replace. We get this expression. And now what we're going to use is we're going to use the expression for B we have there. And if we replace, we find that it's equal to 1/2. So what does this mean? It means that the fraction of trading coming from the insider is equal to 1/2. So it's independent of model parameters. In particular, it is independent of the volume of noise trading. So that's a bit surprising. So why is that the case? It would seem that if noise trading increases, then the share of trade which is accounted for by the insider would decrease, right? Well, actually, no. Because when noise trading increases, what's happening is that the market is going to become deeper. But then when the market becomes deeper, the insider will trade more aggressively. Okay, so an increase in noise trading is going to trigger an increase in trading aggressiveness of the insider in such a way that the relative amounts of noise trading and informed trading are going to remain the same. Okay. What else are we interested in? We can be interested in market efficiency. And so how are markets reflecting the information that we have in this model? And so this can be measured, so as in the Grossman-Stiglitz model, by this measure, which is an inverse measure of the residual uncertainty. Why is it the residual uncertainty? Because this is the variance of d tilde conditional on P. So once you observe the asset price, what is the residual uncertainty about the value of the asset? Okay, and so the larger this is, the more markets are efficient and the more they transmit information. There's two polar cases, and cases 1 and 3, and then there's what happens in this model. So in the first polar case, this is the case without any informed trade. Okay, so remember here, the only informed agent is the insider. And let's say that the insider is not trading. Okay, so the only trades are based on noise. They are not informative. In this case, with the variance of d tilde conditional on P, well, market prices are not informative at all. So this would simply be equal to the variance of d tilde, which is sigma square. Now there's the other extreme case in which somehow the price will fully reveal the information of the insider. If that were the case, then there would not be any uncertainty left, right? Because the insider fully knows the realization of d tilde. So the variance of d tilde conditional on P with a price that is fully revealing will be equal to 0, meaning that this would approach infinity. Now, what happened in the Kyle model? So we are actually going to be in between these two extremes here. So variance of d conditional on P, you should do this at home, right? In the same way that we calculated that. You can calculate the conditional variance, conditional on the price. And you'll find that it's equal to this. Now, if you substitute for the value of B that we have here, you'll find it's equal to 2 over sigma square. Okay, so what does this mean? It means that in the Kyle model, market prices are indeed more informative than they would be without any informed trading. So they partly reveal the information of the informed trader, but they are very far from fully revealing the information of the informed trader or insider, because in principle, this could be infinite. And well, it is not. Okay, and it is all because the insider is trading strategically so as not to reveal his information. Okay, we can also be wondering what are the drivers of the expected profits of the insider. And here we're going to see that the insider is going to make positive profits. Actually, that's a bit surprising, right? Because if you think about it, in this model, by construction, the market maker is going to make 0 profits in expectation, right? So if the insider is going to make some positive profits, so who is losing? Well, if this agent makes 0 expected profits and that one makes positive expected profits, it means that noise traders will be losing out. Why would they be losing out on average? Well, it's simply because their market order is going to move the price against them. So for example, if they are selling, the price is going to drop. So they're going to sell at a worse price compared to what they would have hypothetically gotten without submitting this order. Okay, so they're always going to pay a price, no pun intended, when they are submitting orders. Okay, and so in this case, so they would be the ones who are actually losing money when they are trading. And intuitively, so why is that the case? It's simply because these people are demanding liquidity, and in a model with asymmetric information, liquidity has a price. Okay, liquidity has a price precisely because market makers need to be compensated because they will lose out when trading with insiders. And so what would be their compensation? Well, it would be positive profits when they trade with noise traders. Okay, so noise traders are losing money in expectation. Market makers in expectation break even. But insiders in expectation are going to make some positive profits, which makes sense, right? Because they are the ones with an informational advantage. But so what would be their expected profit? What would be the driver of profits in this model? Okay, so we start from this expression, which are the expected profits of the insider. And as before, we are going to replace for the price. So what is the price? It's equal to this. So we're going to plug that in. But also in the expression for the price, there's X. So we're going to also replace for the expression for X, which is this. Okay, so if we do these two things, and if we replace for X here as well, this is what it's going to be. So if we do all these things, this can be rewritten like this. So try to do it at home, as well as the next few steps. Okay, so what do we have? So we can rewrite this expression. So we're going to have d tilde minus d bar here and there. And here as well, where it's going to multiply this. So here I'm just rearranging and I'm getting this expression. Next, what I'm doing that I'm going to use the expression for actually the relation between A and B here. Using this and the fact that A and B are constant and can be taken out of the expectation, all this thing here is going to be simply equal to this. And then I have the expectation of d tilde minus the expectation of d tilde squared. But by definition, this is just the variance of d tilde, which is equal to sigma squared. Okay. Last, I'm going to use the expression for B. So what is B equal to? B is equal to this. And so replacing, I find that the expected profits of the insider are equal to this. And so this shows that you need two things for the insider to make positive profits. The first one is that you need sigma to be positive. Again, sigma is a measure of the informational advantage of the insider compared to the market maker. The larger sigma is, the more the insider knows that the market maker does not know. Okay. So for example, if sigma were equal to 0, the market maker will already know D as well. And so the market price will simply be equal, well, to the expectation of D conditional on D, which will be equal to D. Okay. So then the insider will always make 0 profit, because here this will be equal to D, and the market price will also be equal to D. Okay, so the profits will always be equal to 0. The profits of the insider are also increasing in the volume of noise trading. This makes sense as well, right? Because the more noise trading there is, the deeper the market is going to be. And so the more aggressively the insider will be able to trade. Okay. Again, we can consider the case without any noise trading whatsoever. And then what would happen? Well, if there were not any noise trading, let's go back to this. So how would the market maker set the market price? It would be equal to the expectation of D tilde conditional on X. But if X of D is equal to this, so there's a one-to-one mapping between D, the information of the insider, and X, the quantity demanded. Well, in this case, the realization of X will fully reveal D. And so the expectation of D tilde conditional on X will just be equal to whatever the realization D of D tilde is. Okay. And so again, in this case, so if sigma u were equal to 0, the demand of the insider would fully reveal its information. And so the profits of the insider will be equal to 0. Okay, so you need these two things, an informational advantage and some demands from noise traders, so that markets are liquid and they are a bit deep, right? Another way of saying that is that if sigma u were equal to 0, there would be a market breakdown. Because in this case, the trade of the insider will fully reveal its information. And so the market maker would be able to fully infer the information of the insider from observing his trade. But then the end result is that the insider would not even trade. Okay. And the idea also is that the market maker would never be willing to trade with the insider. So he would always move the price in such a way that the insider would be unwilling to trade. And why would the market maker be unwilling to trade with the insider? Because the market makers knows that if the insider accepts the trade, it means that the insider is winning, which means that the market maker is losing. Okay, so the market maker will always refuse to trade. So we would have a market breakdown. Market breakdown means that there is no trading. The volume is equal to 0. So by the way, in this market, so why is there some positive volume? Again, it's all driven by the demand from the noise traders. This is what allows the market maker to make profits sometimes when the market maker trades against the noise traders. And so that the market maker is happy to sometimes make losses when trading against insiders. And of course, the market maker does not know exactly when he is trading against insiders or noise traders. Okay, so there's lots of implications. And so it's a very simple model, this Cal model, but there's lots of implications which are not completely obvious at first. Okay. One of them is that in the short term, so liquidity is actually a very important determinant of prices, and information is not the chief driver of market prices. Also, this implies that liquidity has a price. When you demand liquidity, just as liquidity traders do, they will need to accept to buy at a discount and to sell at a premium. So you move market prices against you when you are trading, even when you have no information, because, well, you might have some information, right? And so this is why market prices are moving following market orders. This can also help us understand what is meant by statements such as there's no liquidity on the market, or markets are illiquid. So these are markets which are not very deep. Okay. When is that the case? Well, it can be the case when there is not much noise tradings on, or when there's very strong information asymmetries. Okay. That can be the case during financial crisis, for example, right? Some agents might have some information, market prices are very uncertain, so there can be very strong information asymmetries. Then that can lead to a market breakdown where no one is willing to trade, when trade volumes collapse. Asymmetric information can also explain how market prices react to fire sales. So what are fire sales? These are often massive, or at least unusual sales, and they are often associated with collapsing prices. And so why is that? Well, one explanation is that when there are such huge, or at least unusual asset sales, then the people who are buying the assets are often non-specialists. So these are people who may be less informed. And precisely because they are less informed, they are only going to be willing to buy at a discount. Right? So they're only going to be willing to buy when market prices move in their favor, because they know that otherwise they are very likely to be on the wrong side of the trade because they have less information than other economic agents. Okay. Last piece of evidence is that if you look at the predictive power of asset prices and order flows, you can find that there's actually some information in order flows that is not found in asset prices. Okay, so it's actually interesting in the context of the Cal model, where the order flow will be quite informative from the market maker's perspective. Okay, and that's it for the Cal model. There's some course notes on the course website and some exercises as well, so I would encourage you to look at that.